Good afternoon, ladies and gentlemen. Welcome to our webinar today. Today we'll be speaking about the risk off and risk on sentiment, being the third Thursday of this March. Previously, we've covered correlation of assets. We've looked at the mistakes that you need to avoid in Forex trading. Today, we want to look at how you can understand the risk environment in the market and how you can take advantage of it. And just check out on your platform where you're viewing this, and you can ask any questions. You can type your questions and we will look at them towards the end. Welcome all, and let's see what is it about risk off and risk on that you need to understand in the markets. My name is Matthew. Here we start. So it's very important for you to understand where the environment is in the market, or the environment in the global markets, because you understand when is it risky, when is it not risky, which financial instruments are risky, which ones are not risky, and how do you balance your portfolio, because you don't want to be trading and you don't understand where people are getting cautious and where other traders are getting into. It's very important. So the global economic patterns, of course, they have an influence on you as a trader and other traders. Remember, there are so many participants in the market. We have other traders like you. We have big banks. We have economies, big economies. There are central banks. And so it's an environment that attracts so many participants there. And how all of them are going to behave depends on the patterns that are happening globally, the economic patterns happening globally. And the mood that the activities in the market set is what you're going to look at as risk. Okay, what is the mood of the investors in the economy? Which instruments are associated with risk in the market? Very important. So risk sentiment is just the perception of all the traders, the participants in the market, the investors, and they want to understand, want to give a rating on the uncertainty in the market. Because when there is uncertainty, then of course it triggers a reaction of the market participants on how they're buying or selling the market or what they're investing in. Now, risk on or risk off sentiments is what shapes the perspectives of the traders on assets to trade and portfolio. When you understand when you're in risk on, when you're in risk off, then that's going to lead you as a trader to select certain assets or certain currencies or certain stocks that you want to trade on, depending on how risky you find them or how they're going to help you in maintaining the other portfolio that you have. Maybe trying to hedge the risk, trying to reduce the risk, because you don't want to get phased out when the prices are going so low or maybe in a very crazy volatile move. So risk on, risk off sentiments, very important for you to understand. In a risk on environment, traders have got appetite for risky assets in the market. They can now, because there's a little bit of a calm market, for example, and there's no very fast movement of prices, and you don't have whipsaws in the market. There's not much noise, so then it's easy for traders to catch like a good trend and get into the markets without a lot of risk exposure, and that's during the risk on. And at that time, you have the traders demanding currencies like exotic currencies. Those are currencies from emerging economies, small capitalization stocks that are rising. Okay, there are so many examples we can give there. On risk off environment, the traders or participants in the market want to be safe. Okay, they don't want to go into trades that um, can put them through a very big change, a sudden change within a very short time. Maybe you're losing, and you want to go to where there is a little bit of certainty, or try to reduce the portfolio where there's a lot of risk. So it is risk off, not taking bigger risks. It's trying to protect what you have already. So traders tend to shift to like large capitalized stocks. There are those heavy stocks that, of course, are defensive. Okay, when and out through history, there are some that are known to be defensive, that they will still survive. And here we'll be looking at examples of those type of stocks. Of course, companies that are in the consumer sector or the cyclic sector, right? Those ones are very important. Safe haven assets, these are assets that are considered to be safe, that even when we have um, uncertainty on the other side of the market, these are like stores of value, the assets that you can hold to store value, things like gold, okay, and commodities. That's what traders are looking up to in risk of sentiment. Now that you've understood those terms, let us check out which indicators, which financial instruments, or where do you observe for information or tips on whether we are in what type of sentiment in the market. These are very important indicators because in some way they have a correlation with the risk in the market, and they have a relationship with interest rates, inflation, and the economic growth. Remember those parameters, they were talking about interest rates, inflation, and economic growth. Those are very important parameters that you need to understand as a trader, because they influence the strength or weakness of a currency, or the performance in a given economy. The growth in a given economy is really very much correlated to the interest rates, the level of inflation, and the economic growth. And at that level, of course, um, here we have the central banks coming in, okay, and they help even to give a clear picture on the interest rates and the inflation and their plans on the economic growth. So over history, and as market conditions have been coming up over and over, we've been having recessions, we've been having times of recovery, and it's really dynamic. So the relationships between interest rates, inflation, economic growth, and all these factors that you see here always shift, because of course the market's dynamic. The conditions we are in right now, for example, when we're talking about the coronavirus, okay, the conditions and the aspects and characteristics of that are coming up in the economy, or in the global economy because of coronavirus, is different from when we have the financial crisis of previous years. So it's really dynamic, but it always has something to indicate about where the risk levels in the market are moving towards. And here we're talking about the S&P 500. This is looking up to the performance of the top 500 stocks traded in listed and traded in the US stock exchanges. That one shows the performance. It's like a track of the performance of the US stock market. And here talking about the VIX, yeah, volatility index. That one is given by the CBOE, that is the Chicago Board Options Exchange. Of course, it is based on the S&P 500, and that one helps to see the level of fear, or the fear index in the market. And if it is very high fear, of course, you know there is a lot of risk. When there's very low fear index in the market, then of course you know that there is a little bit of stability. And later on, we'll be looking at how S&P 500 and VIX compares, and how does it help us to figure out. I'm giving you directions on where you can try to get out this information, because the most important thing is you as a trader to understand and be knowledgeable enough and know where do you look up to, and understand the environment in the market, and why is it that you see prices of a given financial instrument moving in a certain direction, right? Because if you understand the bias of the market, yeah, or the likely tendency of the market, and what other traders in the market and even bigger investors are thinking about, then of course there's this common term of the smart money. You hear of the smart money. These are the types of things that they will follow. That's why if you don't understand these trackers and what's really causing certain big movements, then of course your money becomes dumb, because you're not able to direct it the right um, towards the right investments. So again, we check out on the US bond yields. Like currently, one of the fundamentals that has really dominated the markets and has been used to check out on the movement of the financial instruments in the market is the government bond yields, especially the US Treasury yields. Okay, a very good tracker. And again, Japanese yen, it's a safe haven currency. Okay, it's like Japan is considered like a global creditor. Okay, that's where so many countries will go to borrow during times of crisis. Okay, and when you look at the direction of this currency against others, like for example the USD, then you can easily pick out what is happening in the global sphere, in the global investment sphere, right? So these indicators here, these indications here are very important when you want to understand what is the direction, what is the general view of the investors all over the world. Because remember, this you're in a global market, whether you're trading with a euro here or you're trading with a Japanese yen, you're trading with a stock on the FXPesa platform or even any other platform, you are not the only one who is trading. We have other participants in the market, and their actions are going to influence your actions in the market as well. And you don't want to be quite far from what other traders are doing in the market. You just need to understand their views in the market, need to understand the sentiment they have in the market, and then of course you can gauge the risk. You understand, is it risky and which financial instruments are risky? Where do you look at? These are examples of the indicators that you will look at to try and pick out the sentiment in the market. Now, let's try to compare a few of them. We've talked about the S&P 500. That one is a tracker for the US stock market, the top 500 companies that are listed and traded in the US stock markets. Then, of course, we're talking about the market volatility index or the index sphere. It's given by the Chicago Board Options Exchange. And initially, that VIX was used, it is, even now is used in pricing the options, the put and call prices for the options based on the Scholes model. That's a model which is used in pricing the options, right? And it is based on, of course, the prices and other aspects that will indicate the fear in the market. So when you look at the comparison here, this chart, I took this chart in the last week of February, okay? So not quite far from now. And checking on that chart, the VIX is represented by the blue line on the chart, and the red one is representing the S&P 500 stock index. All right. In our chart, you will find the S&P 500 as a US 500. So for you to understand this one, I want you to note the levels between March 2020 all the way to September, December 2020. After that time, on March, so we're talking about 2019. Sorry, talking about 2019. From 2019 all the way to 2020, around there, you can see that VIX was really below, low, very low. It is below the S&P 500 index because the S&P 500 index was indicating low fear in the market. The S&P 500 was really high. The VIX, which is so low, is indicating low fears in the market, and the stock markets was really performing pretty much well up until 2020 March, right? That's when we had the news of coronavirus coming up, right? And at that point, we have a switch of that the price is there. You can see what was happening. So rising of fear index causes sell off in the stock market, and investors are trying to cut off the risk in the market. Falling of fear index, that blue line there, it is showing the booming of stock markets as investors are trying to venture into into buying stocks, and of course there are lower uncertainties in the market. And you can check out there in the Q4 of 2020, in the last quarter of 2020, that's what I'm talking about there, where you're seeing the VIX spiking up, and then you have the S&P 500 falling. So we had expectations of early vaccine in 2021, and peaceful changes. Of course, we had a transition in the US, and that one brought about optimism in stabilizing of the US economy. So this is a very strong indication of the sentiment in the market. You can see that at March, during March, then of course the stocks really went um, went down. Okay, they fell very much. So when you have low VIX levels, then that one means that there is low fear in the market, right? And that's when you see the stocks soaring higher. Okay, but when we have shock in the market and there's high fear in the market, then you have the VIX shooting up all the way to those levels. That's a comparison of the percentage, and then you have the stocks market falling. So again, it's a measure of the fear in the market. If there's a lot of fear, then it's risky, and you want to, we are risk. We in risk of sentiment. When there's a lot of fear, then you need to take a back and cut off that risky investment that you might be holding, or risky portfolio that you might be holding. Next, talking about government bonds. Specifically here, we're looking at the German 10-year yield, UK 10-year yield, and Treasury 10-year yield. Again, this was taken in February, last week of February. And when you're looking at those yields, where you can get these yields, you can find out websites that you can compare them. Okay, so this one will give direction about the economic growth and the inflation. And whenever you're checking out about the government bond yields, you just want to understand what is it, what is the direction of the economic growth in that given economy, and where is the inflation moving in that economy, right? So when you see a normal curve or a steady rise of bond yields, then it means there is economic growth, okay, economic growth, and there is higher future inflation coming up, right? When there is a flat yield, and you can see there between the months of April 2020, that's when we had really economies were hit by the coronavirus. Around June there, okay, around June there, July, you can see a flat yield. There is uncertainty in the market, even in the short-term and long-term economic growth projections, not very promising, right? But when you're coming towards the end, start of December, January, February 2021, you can see that the curve was a little bit moving upwards, okay? And that's when it's showing optimism, okay? Signs of economic growth coming in. And you see signs of economic growth coming in and rising bond yields, then it's a representative of, yes, um, now people are starting to, economies are starting to get excited. There's some economic activity resuming, right? And that's why, because the bond yields will represent there's a relationship between bond yields and the interest rates, right? So whenever the bond yields are increasing, then it means that there's a likely increase of some interest rates, and of course there's some likely setting in of a little bit of inflation, right, or reflation in the economy, and that one really shows that economic growth is setting in, and people are going to go to stocks buying. Although there is a tipping point between the rising of interest rates, the rising of bond yields, and the performance of the stocks. Because again, if the bond yields continue rising so sharply, that's what you've been seeing for the past like 1 week, a few weeks ago, right? Like 1 to 2 weeks, sharp rise in bond yields. Yes, they're indicating a likely rise of economic growth, and the economy is starting to stand up again on its feet. But again, we don't want to see a level where the bond yields are so high, higher than the returns that you're going to get on other assets that are in the market, because that one again will mean that people or investors will want to go to where there's a higher, because at the end of it all, we're looking up to see, someone is looking up to get higher yield. So if there's a higher yield in the bonds, then someone is going to go to the bonds. And again, that is what has really been causing, like for the past like 1 week, falling of the stocks, because the yields are really surging. And then as they are surging, then of course it means that the interest rates are a little bit rising as well. So that's where you can see what sentiment is in the market. It really triggers the actions of the investors in the market. So decreasing yields again shows slow future economic growth with low long-term bond yields compared to the short-term. So again, something very important is, it is important that when you look at the performance of an economy, you can anticipate a gradual increase in interest rates. Mark my word, gradual increase in interest, not a sharp increase, but a gradual increase in interest rates over time. And what that one means is that when you're comparing the long-term bond yields and the short-term bond yields, the long-term bond yields should be showing a little bit higher interest rates towards the future, right? And in the short term, it means they should be a little bit lower if we are in a healthy environment, right? But now, when you have decreasing yields, like you can see in the months of February here in 2020, that's when the pandemic was really hitting hard on all these economies that you see globally, and you can see the yields were really dropping and dropping and dropping, plummeting, showing slow future economic growth. And now the short-term bonds are having higher yields than the long-term bonds. That's when it's a representation of a bleak future. And of course, that's when it's going to show that it's time to get to risk off. Yeah, time to get to risk off. Right now, as you can see, as from December, January, February, the bond yields are a little bit spiking upwards, right, turning to gradual. But if you look at towards the end, then you can see they are a little bit sharp. That sharp rise is not very healthy, but a gradual rise is healthy to indicate that we are now recovering, and it's time to start getting from risk off to risk on environment. Okay. So next here, Japanese yen. Again, Japanese yen is a currency which is very defensive when it comes to times of risk. So a strong Japanese yen signals risk in the market, because investors are trying to turn to safe haven currencies. They want to buy the yen. They want to reserve their money in terms of a strong currency that has historically held its position against the the market conditions, or worse market conditions. So a weakening Japanese yen signals risk on sentiment, because people are turning to high yielding currencies, and the currencies are becoming stronger because there's increasing demand as compared to JPY. So we have several strong currencies, but we're looking at Japanese yen specifically because during times of crisis, you have several countries going to borrow from the Japanese government. They are more of a credit, or a global creditor, right? Offering credit to so many companies because, of course, of their known low interest rates all along. So if you can borrow from a low interest rate and pay with a low interest rates, then that's very attractive, and that's the currency you want to go to during times of crisis, right? So here, the currencies you can watch out for: Australian dollar, Japanese yen. Here we're talking about the Japanese yen factor. And look at this movement for the Japanese yen. When you watch out from this chart again was captured, I captured it as from the end of January, the last week of February. And you can see that around March of 2020, there was really a very big spike. In this case here, it was a very big fall, people selling off dollar, buying Japanese yen, right? Of course, I don't know if you understand that, because when you see this drop, it's a sell off the US dollar, buying of a Japanese yen. But then because of that, of course, also remember USD is a safe haven currency. But in the long term, you can check out from April all the way going on to December, it was a gradual sell-off of it was a gradual downtrend for the two currencies, right? A gradual downward movement for the two currencies, and then towards 2021, we can see um, a rising uh, value of the USD as well. Okay, so in this case here, when you try to check out, you can see that when there is a very fast and a very big effect in the market, like a risky sentiment in the market, people will turn to a safer haven asset. So risk of assets to consider, of course, they are considered safe to trade in risky market conditions, and factors you're considering for these safe haven currencies, you look out on the economic growth, the political stability, and the liquidity in the market. Examples, defensive currencies in times of negative market sentiments. You have US dollar, Japanese yen, Swiss franc, and euro. And for major currency pairs, then you're looking up to Euro USD, USD Swiss franc, and USD Japanese yen. Those currencies, they won't take very big, generally, if compared to others, they won't take very big spikes in the market. And you can see here it's been like a gradual downtrend. This one was taken on a daily time frame. And you can see it's a gradual downtrend. Even if you can see spikes, they were really at times when if you compare with other currencies, would have been really very, very big. During this off, there's less sudden market price spikes, there's stability, and during this off, less sudden market price spikes, and there's stable and calm market. So the strength can stagger, of course, depending with the events in the market. Commodities, you're looking up to gold, considered as safe haven asset, and investors will prefer to convert or move their currencies to gold to protect, of course, against the loss of value. And again, even silver is part of that. Checking up, checking up to the stocks or the stock side, in the risk of sentiment, we have various, of course, we have companies in various sectors. We have companies in consumer sector selling household products, in the utilities sector, right? So we're talking about non-cyclical companies. That's what you focus on in risk of sentiment, risk of times. And we talk about non-cyclical companies. These are consumer staple retailer companies like food and beverages. Whether there is a crisis, whether people are not going out, people must eat. And that's why companies that were selling food and companies that are known to sell clothes and other very important products, of course, they could not go down. Okay. Household products, retailers, of course, household products were really on demand during those days. If you remember, using their detergents, those type of things, really very important. So those companies were still getting economic activity, though not as high as when there is little or no crisis. Consumer staple stocks like Procter and Gamble, of course, these are manufacturers of home care products and such. Utility stocks like water and electricity, whether there is a crisis or not, people have to drink water, people need lighting, people need warmth. So these are the stocks to look up to when there is risk in the market, and these are the stocks that were really attracting a lot of investors. Or are really, let's talk about being defensive, because as well they scaled down because the level of demand of the products must have gone down, because of course people were losing their purchasing power, they're losing jobs left, right, and center. That's what happens when there is a crisis. And checking out here, of course, we have technology heavy index, the Nasdaq, with the consumer staple index. We're trying to compare from 2020 to 2021. If we check out here, around March, April, that's when there was a really big toll on this coronavirus. And you can see At that time, all the sectors were affected equally. But getting along, of course, you can see that the blue line is representing the Nasdaq, the UT 100 technology input technology. The blue line is representing the consumer staples, sorry, and the red one is representing the tech index. So this crisis has been a special one because it is a time when people were demanding more of the technology, even as they require the consumer staples products. They also demanded more of the technology. Zoom, we're talking about Zoom, we're talking about buying products via online channels, things being delivered. There's no going outside physically, things being delivered. So technology was on very high demand. So checking out very well there, you can see that the blue line, which is representing the consumer staples, it was a little bit higher, which means that the consumer staple companies or companies in the consumer sector, they were really defensive and they were performing better as compared to the technology. Because I'm trying to consider technology here as something that is a little bit of something that's not really very important or very critical when people need survival, right? But people are cutting off products that are not very vital in their life, and then you're looking at something that's going to help you in survival. Okay, but because of that, this special time during the coronavirus, you can see there was that gradual rise, all of them, but a little bit consumer staples being higher. Now, towards the end, you can see a switch point in 2021 around January, February, March. You can see that consumer staples went down and the technology is going higher, right? Because now, as we are switching off from the risk off sentiment to a little bit of risk on sentiment, then there is more demand and there's more growth in technology. People are now consuming more of technology in a little bit higher level as compared to when there is a crisis. But still, because staples are really very important, they don't drop that fast. So this is again something that can indicate what is happening in the economic environment. Now, how do you trade during risk of market conditions? During risk of market conditions, the environment is negative due to panic in the market. Risk of the you don't want to take a bigger risk. So the moves in the market are very fast. That's number one, very volatile, moving up and down very fast. Sometimes you're not even able to get the best entry or exit in the market. Stop loss and take profit executed with a lot of slippage. Slippage is where you've placed your take profit, but there is some it cannot be taken at that price level because it's not even there. Right, the price is not there at that current move at that current time, right? So how do you manage that? Make sure you manage opportunities and risk because you don't stop trading during risk off or risk on time. You have to be trading. Remember, it's your source of income. But then, how do you sail through that period? You use tight stop loss levels and you protect your profits. Okay, this is the time that you need to make very good use of trailing stops. And if it's a stop loss, then you know the markets can move very fast, right? You use calculated moves and you cut off your risk by using even lower lot sizes. So again, you can reduce on risky assets, adopt safe haven assets. And if you're trading with currencies, very risky currencies are the ones that are exotic or from emerging economies. Exotic currency pairs are a little bit risky or very risky because they've got wider spreads. And when the markets are moving, then you can have um, a very big move within a very short time. Okay, and you don't want those quite spiky candlesticks when you're trading. You want to see a moderate volatility in the market, not very high volatility. So you want to go to like safer currency pairs I've mentioned, Euro USD, USD Japanese yen, currency pairs. Of course, all the currency pairs from the major or the majors are considered a little bit safer. But of course, we have the USD Japanese yen, at the top of that list. Then hedge your positions or diversify. During those days, if for example you are making losses and you're in a trade which is really in a very uncertain financial instrument that is spiking up and down very fast, or you've been experiencing losses in your stocks, for example, you bought a stock and it is really falling and falling, that's where you get into hedge. You take an opposite position, but of course, for stocks it's different, right? For stocks it's different, and when it comes to currencies, you take a position on another currency that you know they have a different relationship, like a negative relationship or a positive relationship, but you take a different direction. Okay, so that you hedge your position and reduce the risk in the market that you're facing. So during risk on market conditions, meaning that you can take on risk, you can risk, you can speculate in various risky um, financial instruments. So risk on assets perform better when the market sentiment is positive because they have got higher yields, and they are riskier because there's considerably high volatility. So as a trader, depending on your appetite, you can trade risky assets or maintain safe assets, because as well, even safe assets will move even during risk on times, but they won't be on high demand, right? So it's advisable to have a diversified portfolio during risk on times. A time like now, we are getting to risk on sentiment. We are already in the risk. We're getting into the risk on sentiment. Of course, we have hiccups here and there because the COVID-19 seems like it's not going away anytime soon, right? Now resurfacing in various strains. So you still need to have a diversified portfolio, have a mix of risky assets and moderately risky assets, and then you have low risk assets, and know of those financial instruments or maybe currency pairs you have, which one can you use to hedge the other? Because sometimes it's tricky when you want to, like, you've taken a buy trade in one, you've gone long on one position on one currency pair, and on the same currency pair you want to go short. Sometimes it becomes tricky, and you want to identify another currency pair that they seem to have almost the same relationship, and a positive or negative correlation, and you see how you can hedge up on your positions. Remember last time we talked about correlation. Okay, so it's my hope that we have really been checking out on the flow of these webinars, because now you should be able to understand uh, what how they are correlated. And coming in now to speak about how you can hedge when you're forming a portfolio. Make sure you have in that set of currencies and financial instruments you have, at least you have, there's a way in which you can hedge a position in one financial instrument with a position in a different financial instrument. For the currencies, you're generally looking at miners, exotics. They provide very good opportunities during risk on times, and due to moderate volatility, again, you can trade on them, and even on the majors, because on risk on times, it is time that you can risk more by going to those riskier assets, because now the movement is not very uncertain, but still even on the safe haven assets, it can give you a move or a good opportunity. On the stocks, check out for the momentum stocks. These are stocks that can rise very fast in short term, and these are like small capitalized stocks, cyclic stocks that perform during economic expansions. And if you check out on our platform, you'll find out so many are being added, so many small capitalized stocks, right? You're talking about Jumia, talking about Chewy. There's so many stocks you can find out there, and even so many of them are being added every now and then. So cyclic sectors, you're talking about airlines, okay? And that's a very good example, because right now there's a reduced travel. There's reduced travel across the world. So it's cyclic. Hotels, you do it out of luxury most of the times. Okay, so when there was COVID-19, then people reduced going to their hotels, right? Restaurants, automobile, yeah, where you even buying a car, and there is no traveling so much. People are in either in lockdown and those type of things. So when it comes to risk on, now people can go to these cyclic financial instruments, stocks in the airline sector, stocks in the hotel sector, restaurants, automobile, because that's what had been scaled down when there was a lot of risk in the market. But now um, they are little by little standing up on their feet. Airlines starting now uh, to proceed with the operations. Hotels starting up their operations, and that's why you're looking up to see those stocks for those various sectors and can give you some good um, entries into the market. Sometimes it's good to buy on the dips, okay, because of course in the future, of course, in the future, you are expecting growth in the economy. So what are the action points I should be taking from this one here? The action points you should be taking from this presentation is that you need to know your risk profile. I hope you can hear me clearly. You need to take consideration of your risk profile and you shift with sentiments in the market. Okay. There are times when the financial instrument that you're trading, if it's a currency that you are trading over time, you realize that there is changing in the movements. It was not maybe very volatile, now it's turning very volatile. What does it mean? The way to understand it is to understand the risk sentiment in the market. Be conservative, trade risky assets. When you're trading risky assets, be conservative. A conservative trader means that you're not trying to anticipate, you're not trying to place a trade based on your anticipation, but it is based on a confirmation. Take time to wait for confirmation in the market, especially with risky assets. You don't want to be very aggressive. You need to be really conservative. Follow global events in the Forex market. Here we're talking about the economic calendar. Know what is happening. And currently, maybe to mention, there's a lot of news about the bond yields, about inflation, about interest rates. And those are the factors I've told you where you can check out for. Inflation, interest rates, and even the bond yields, right? So check out for those events on the economic calendar, know what is happening globally. That will help you. Be dynamic on your trading strategy to suit different market sentiments because the market itself is dynamic. You don't want to get stuck to the same trading strategy. Even when there is very high volatility, you're sticking to the same trading strategy. When the volatility goes down, you're still using the same trading strategy. Of course, at some time it will be giving you better returns, and sometimes now it will be giving you low returns because you're not adjusting to the changing market dynamics, right? So, and from my end, ladies and gentlemen, that's what I had for today. And now I just want to hear your questions regarding that. You can type your questions there. We look at them. So first, as is asking, does it mean that check on bonds, interest rates, know the market sentiments? Yes, those are the indicators, Festus. Those are the indicators. When you understand the movements in the bond yields, the movement in the bond yields, it gives you a likely direction of where are we getting into, right? When we have the trend of the bond yields rising very fast, spiking up very fast, of course, at a time when we are coming from low economic activity, then it means that we are getting from a low economic activity to a higher economic activity, getting into the economy now. We are no longer in the risk off sentiment, or getting to the risk on sentiment. Yeah. And of course, the bond yields and the interest rates have got a correlation because when the bond yields are rising, then of course the interest rates are rising. So if you check out when there is an economic crisis or low economic activity, the interest rates, so many governments look for one to maintain low interest rates because lower interest rates, of course, are giving people, are trying to allow people even to borrow and get and get more money from the lending institutions. That's where we have been on, because there's low supply of money, right? So over time, if we're looking to get whether there is a rising economic activity and rising bond yields, of course, showing a higher economic activity, and then the rising bond yields, of course, indicate that there is a little bit of rising interest rates. That one indicates it is instigated by economic activity. So that one shows now that people, that investors are getting onto a little bit of activity and trading and reducing the fear in the market. Yeah, yesterday someone is asking about whether I can shed a light on what happened on the gold yesterday at around 11. So yesterday, remember, that's why I say it's very important for us to follow the news. So yesterday we were waiting for, let me check out for the economic calendar. Yesterday we were waiting for the Federal Open Market Committee meeting, or FOMC meeting, and the announcements of that FOMC meeting, what they were going to speak about there, by the way, is on the economic outlook and the interest rates decision. And the decision of the US central bank yesterday, or the Fed, is that they are going to maintain even lower interest rates, right? They are going to maintain lower interest rates. Okay, lower interest rates means low means weakness of the US dollar. Again, it means that they are not really worried about the inflation. That is why they are keeping the low interest rates between 0 and 0.25. So the release of that information showed a weakness of the US dollar, and of course the likelihood of some inflation. The central bank not really very much concerned about the inflation, and of course they talked about an expectation even of higher economic growth, and all that information about the US that's affecting USD is coming up when there has been a release, or the stimulus has been released. So a combination of all that caused that spike in the gold, right? That was caused a spike in the gold prices, all the way from the from the 1720s all the way to 1750, right? Though we saw some pullback today. That's what happened yesterday. Good questions there. Good questions there. That's what really happened. So interest rates and the expectations of inflation and economic growth, that's important information that we need to be happening. So Brian, that's what was happening. Correlation between Swiss franc and pound. Well, all those currencies, Swiss franc, Japanese yen, and GBP, those are really very defensive currencies, though over time there has been talks in the market, of course, because of the uncertainty in the UK about pound being a safe haven asset, but still it's a currency from a big economy, right? But here, if you're talking about the safe haven currencies between the Swiss franc, Japanese yen, and GBP, here, of course, we're talking about Swiss franc, a very strong currency, very defensive, and Japanese yen, so defensive. Yes, Maureen, on the fear index, the VIX. VIX is the measure of the fear index in the market. When the VIX is rising, then it shows that people in the market have got a lot of fear. There's a lot of fear in the market. There's a lot of uncertainty. When you have fear, it means that you're not quite certain, or you cannot lock like a high probability of the movement of a given financial instrument, or you cannot even. There are some times when you see the market seems like quite irrational. That's what I'm talking about, the uncertainty. Then it brings about fear. So VIX represents that. When the VIX is rising very fast, it means there's fear in the market. That is the time when you have the investors in the stock market like cutting off their portfolios. Yeah. So I hope it's clear on VIX. It's a fear index. It's based on the US 500 roll. Brian, good question. If you want to get the information on the meetings of the Federal Reserve and all that other economic calendar events, check out on the economic calendar, right? And the key events you'll be looking out for is, of course, there's the interest rate announcements. Those are meetings um, by big central banks from those big economies like the Federal Reserve, looking about Bank of England, looking about the Bank of Canada, um, the European Central Bank. Those announcements and from those other big economies, they're very important. They speak about the economic growth projections, speaking about the interest rates position, how they're going to react about the inflation, and their monetary policy plans. So you check out on the economic calendar. Just go Google economic calendar, okay, economic calendar, and you can check out on all those events lined up, right? There's also information about a consumer price index, about inflation, can really help you to know the weakness or the likely coming up of weakness or strength of a currency. So good question there. So again, on the FXPesa platform, we have them as well. If you go to the FXPesa platform, you can find the sentiment analysis, and there's an economic calendar you can utilize in your trading. So for the announcements, check economic calendar. It's on the FXPesa platform, or if you don't find it, you're not able to use it well, it is very easy. But if you still want to check out for another one, go and Google economic calendar and you can find out more insights about it. All right, ladies and gentlemen, thank you so much for being part of this. I'm happy to interact with you. Next week again on Thursday, we will have another interesting topic. Make sure that you register and we will see more into what you can use to make your trading even better. Thank you. See you next time.